super excited because we've had a lot of positive stuff go on in the property market just in the last few weeks. And stoked to see so many people on this webinar and so many people finally a bit excited and a bit positive about the property market. And it's come from a lot of things. And one of the things that I'd like to say tonight is just so much positivity. So first one is, number one, OCR is down 0.25%. And it looks like most of the main banks have pushed that through to retail lending. So cash rates and short-term stuff have come down a bit. And it looks like the entire 0.25 has gone through to the fixed term rates between 1 and 5 years, which means that banks are getting really competitive again. They really want their market share. Additional to that, test rates have come down. So this is the rate that the bank is using to help you figure out whether you can borrow more money. So this is not only the rate on new lending that you're looking to borrow to buy new properties, but it's also the rate the bank's using to look at your existing lending rates and whether they're at the right place or not. And so when test rates come down, most investors who have a few properties can borrow some more monies. Also, at the moment, banks seem to be pretty flush with actual cash. And I know Matt's got some thoughts on this shortly, and I'll jump over to him very, very soon. But also, it looks like banks have got a lot of money to actually lend, and they're starting to look at their market share. They're starting to look at their portfolio and try to lend more money again. Fantastic for investors again. Additionally, we have about 7,500 additional properties on the market now than we had 90 days ago. So we've had a really big boom of properties coming into the marketplace very recently. And this is pre the spring boom, which is pretty exciting as well, because it gives us as investors not only a lot more selection of the properties that we're looking to purchase, but it also means that with the same number of buyers in the market, or maybe a few more buyers, there's a lot more properties in the market, so we don't necessarily need to compete quite so much. Additionally, in the next couple of months, we're going to have the traditional this year time of the year spring boom, which means a lot more properties coming onto the market on top of that. And that means that we've got, in some places around the country, up to 40 weeks of stock sitting on the marketplace. So some positive things there as well. And all of this obviously ends up being pent-up demand. Now, we see this an awful lot in stagnant markets and markets that are quiet, but it basically means that there is a lot of people out there that really want to buy something and they haven't yet. And so they really want to get something done. Now, and this is why I'm going to be asking Matt very shortly, when I chuck him up on the screen here, what he's seeing with the mortgage market, because I know that he's been talking to both Chris Peterson and Dave Windler very recently about how many applications are going in, which is the start of this really exciting period, if you like. So without missing too much of a beat, obviously our guest tonight is Matthew Gilligan from Gilligan Rowan Associates, who I will chuck up on the screen there with us right now, who's sporting a resplendent background of his new home office. Very nice. Good stuff, Matt.
Very good. I'm proud of my bar. That's the key feature.
Excellent. Just wait till the end of the webinar before you get tuck into that. That'd be great.
How are you, Steve?
Yeah, great to hear from you, mate. We had a really good chat this afternoon, throwing the marketplace around a bit and seeing what's going on. And I'm really interested to see what you've come up with to present tonight. But firstly, Matt, founding member of Gilligan Rowan Associates, you've been there how many years now?
Well, I mean, Gilligan Rowan started with me. So first it was me when I was at uni, and there were no others. So, I was at uni when I was 23, so 30 years ago, the business started. And maybe 10 years later, John Rowe joined me. So he's been there for 20 years now. A lot of the staff have been there for 20 years. I would like to just start and say I apologise in advance for my voice. I've had a terrible bug, and every now and again my voice disappears. So if that happens, Steve, you can take over. But look, Gilligan Rowan are chartered accountants. We're popular with investors because a lot of the directors invest themselves. So I have a lot of buy to hold properties. I build properties. I subdivide land. I trade properties. I do it in JVs with my business partners. One of them in particular in the practice, Celeste Chand. We have a good portfolio together. And one of the consistent things, I guess, across the years of GRA has actually been Steve Goody, because there's been different iterations of people out there starting property education businesses. And one of the consistent people that have bounced between these businesses is Steve Goody. And so once again, we're on your brand now, Steve. That's great. We know that's going to stay there.
Yeah, appreciate it. I've been doing this for 20 years now as well. 20 years plus now.
Yeah, that's right. You and I are last people standing.
Pretty much.
We're the old guys now. When we started, we were the young guys.
We really were.
Yeah. So Steve interacts with the same people I do: investors, mortgage brokers, accountants, lawyers. And it's interesting to hear their perspective, because actually lawyers, brokers, and accountants are the first responders to either downturns or upturns. And so we've got our finger on the pulse. And of course, real estate agents. So this afternoon, I rang some of my favorite brokers. I rang some of my favorite real estate agents. I talked to one of my lawyers and to some of our accountants. So I was going to feed that back to you, because it's a week out from the OCR dropping 25 basis points. And we're already feeling that there's some resuscitation back in what is a very recessionary environment. I think there's optimism returning.
It really did go through the market like an earthquake, because it was unexpected. And I think that was one of the things he used.
It was unexpected 4 months ago, but I was talking to David Seymour in April, and I actually asked for a meeting with him, and I said to him, "Do you realise how much damage Adrian Orr is doing to this country? Structural damage. People are leaving the country because there's just so much pessimism. There's no work. Rates are so high. Cost of living is so high. It's better in Australia. Businesses are closing. Businesses are failing that didn't need to fail because rates have been kept so high for so long." And it's like he didn't get the memo. Everyone on the street knows that cars aren't selling, retail's not transacting, property's not selling, people leaving the country, and he still thinks it's inflationary. It clearly wasn't inflationary. He was just waiting for it to be reported to him that it wasn't.
His favourite cafe at the bottom of the terrace closed down the other day. Didn't turn into something else. Didn't change hands. It literally closed, is now an empty building.
Yep. When I was on your stage in March, was it? I said in March, what the best thing New Zealand could do, the best thing would be to fire Adrian Orr, and to immediately drop interest rates and try and resuscitate the economy, because he pushed rates too high in 2021, too low, overstimulated the economy, and created a housing boom, created massive inflation. So the whole problem of inflation was his problem. Sure, we had central government with too much money being spent. So Grant Robertson was equally to blame, but he's out of the picture. In came the new government, and they've been fixing a lot of the problems that were created under the Labor government, especially for investors. But Adrian Orr should recognise that he overdrove the market too high. He should learn from his mistake and not driven it too low. But he's just kept his foot on the throat of the economy too long, and it's just done so much damage. We see it. Our clients are going into liquidation. They didn't need to liquidate. If you had eased off a bit earlier, just be a bit more moderate. What would be my message to the Reserve Bank? You don't need to push massive inflation, massive recession. Try and draw the line in the middle and be a bit more moderate. And I don't think he's learned the lesson, although he has dropped rates in the last week. But he is fixing his own inflationary mistake, and he's done a lot of damage as he's done it. Yeah. So I rang a couple of real estate agents this afternoon in Auckland, and I rang Megan Jaffe from Ray White in Remuera. I like ringing her because she's 60 to 100 million a month. She's a big real estate agent. That's her sales. She's number one in Ray White globally, and so she's really got a foot on what's happening. So I rang her as I was driving home this evening, and I said, Megan, what's happening? And she said, well, it's already so much more positive just because the Reserve Bank's saying they're going to drop rates. She said there's a little bit of FOMO creeping in because everyone knows prices are going to go up. So people are now saying, I better buy now before they go up. She said only half her stock selling under the Hamlet auctions, but post auction at 75 to 80%. She describes it as a very normalised environment, bubbly, happy bidders. Everybody's agreeing that now's the time to buy because asset value is going to go up. She said that there is an overhang of terraces, small shoeboxes. Far too many have been built, and that's an overhang in the Auckland market. I think that's in other markets in the country too, Christchurch included. So then I rang Kelvin Roche from Barfoot's out west, and he said that there's a lot more demand in the last week. He said it's starting to rocket. He said he's getting pre-auction offers and multi-offers, and he hasn't seen that for 18 months. He said it's especially for older homes or freestanding homes. He said terraces are still slow, and there's an overhang of them, so echoing what Megan said. And he said that rents are still slow up here, down $50 per week on average, which leads me to the negative point I want to make. Excuse me. Everybody talks about demand for property in terms of applications for finance and what's happening in auction rooms. But I actually describe at a more fundamental level, Steve, demand as population growth within an area. And that is all about immigration. Long-term, it's net births and deaths, but immigration, the elephant in the corner that is not being discussed is immigration is flat at the moment. It's break even. Slightly negative or slightly positive last 2 months. And why is that? Well, one of the key immigration settings that is driving it is people who are in the low wage economy seeking to renew their visas are actually being forced to leave the country for a year before they can reapply, which is insanity. And I said that to Seymour in April. I said, do you know this is going on? He said, this is insanity. So it is a mistake. I think it will be fixed. But I had a farmer, a mate of mine in the South Island, telling me that farmers are up in arms about it because they've got these migrant workers. They've trained them. They've been in the country a couple of years, and now they're being forced to leave. And, of course, they're never coming back.
Yeah.
Another guy said to me, he's a financier. He finances cars for car yards. He's quite significant financier in the Auckland markets. He's a client of mine. He said to me that they're getting 4 cars a week driven to the airport and just left at the airport, and less cars, and they just go pick them up and they have to resell them because the migrants are getting kicked out of the country, and they're disgusted with New Zealand. Another Asian client of mine, young lady, said to me that there's a joke amongst Chinese at the moment. She said the joke is, how do you reduce your cost of living in New Zealand? Buy a ticket to Australia. So this is terrible. This is, in terms of property economy, this is the demand for our rentals. This is the people that want to buy houses and make a living here, who have learned our ways. They're leaving the country. So,
and this is immigrants that are leaving, and that's not even accounting for the locals. The young people today that want to earn a bit of buck, and they're all going to the UK or to Australia or wherever. And you know, and what are we getting in exchanges? Like, you know, is not enough. It's not enough to fill the gap.
So I don't want to be negative, but what I would say, the positive of this is that there is an overhang of small terraced houses. We've built too many all over the country. The rates are going to drop. Investor sentiment's going to improve, but I think rents are going to ease, and developers will stop developing those little terraces. They'll hang back. Hopefully the immigration settings get reset. We get more migrants coming in, and as that happens, you'll get the typical climb out of the hole. Rents will go back up. Asset values will stabilise for those assets that have currently got too much stock on the market, like the terraces. But the freestanding townhouses, they're going gangbusters in Auckland. They're selling. They're getting good prices. And Megan's telling me that, and Calvin's telling me that. So, Steve, if you don't mind, I'll just move on and get through a few of my slides. But yeah, look, I'm a chartered accountant, but I sit on the board at GRA these days, and I run a property portfolio. Celeste and I have sort of, I'm going to say 50 houses together. So we're reasonable sized investors. We also, and we say The best money's in the long-term money, and we love to buy and hold. But of course, if you can trade and make money, creating equity, buy and sell, or buy, develop and sell, that creates more equity for you to put into your buy and hold portfolio. So that philosophy runs through us, and we've been on your stages for years, Steve, hearing you preach similar stuff. So we're all on the same page. But it makes us good tax advisors, because not only do we understand the tax, we also understand the game. So as a bit of an update, I wanted to quote John Butt from Wellington. He's got a Substack of data that he produces, and he said mathematically on his index, the country actually bottomed out mid-2023 on his index. So these are post-bubble low prices by region, and they all bottomed out roughly mid to late last year, and they're all climbing out on his index. I certainly think that we're at the bottom. I agree with that entirely. We're in the downturn, we're bumping along the bottom, and with interest rates now dropping, we don't have demand on the immigration side, which is a shame, but we have demand driven from a desire to own your own home, buy houses, or get into the property market because you can with dropping rates and renewed optimism.
Yeah, and for my money, like I was never any more surer than when interest rates got to 3% that was about as low as they would possibly go. And I haven't been sure of anything more than that till now, when I'm sure that we absolutely are at a point where if you buy something now, in 6 months' time, you're going to look like you were pretty smart.
Yep, I agree with that. And a number of different people are saying, oh, we're calling the bottom of the market now. I'm on board with that. This year's the bottom of the market. All things being equal, assuming we don't have the sky falling overseas with a war or something, or Wall Street tips.
A lot of people going on with that whole survive till 25 thing, survive till 2025, you'll be fine. I think you got to look back and go 2-3 months ago was the start of the bottom. We're actually at the actual physical bottom now.
Well, look, we're aggressive investors. We're always putting offers in, so we buy a lot of houses in Rotorua. We haven't managed to buy a house in Rotorua for 3 months. We are constantly lowballing, and we buy them all if they come in within our parameters. We haven't been able to get any, so we're just getting overbid. And Celeste said to me this afternoon that our local clients are turning up. This is the local clients with well-heeled, plenty of money. Money's no object. They just set commercial parameters. They're turning up. They're getting overbid. They're not getting anything either. Am I fading out there? Can you hear me okay? Yeah.
Yep, fine.
Yeah, so our Auckland investors are getting overbid now. Everybody's been absorbing stock in the down market, ourselves included, but we're starting to get too much competition.
Yep.
Which means we're going to have to pay more, I guess. But as you just said, Steve, there's a big increase in the number of rental properties listed, and I think this is from accidental landlords to a certain extent, people downshifting and they can't get the price they want for their property, or they can't afford their home, so they move out and rent their home out. People wanting to buy a second home and they'd rather sell their home later, or baby boomers going into retirement villages. But there's a lot of stock in the market at the moment, and the migrants aren't coming in. So, yeah. So this is all part of a property cycle, and while it's obvious, and we all know this, it's not a bad thing to remember that we've got a cycle running across the top of us. And if you look back 40 years, the peaks were 87, 97, 2007, 2017. And so the next peak should be 2027, and we should be in the middle of the downturn, and we should be 3 years out to the next peak. But actually something happened in 2021. The cycle got disrupted. We had a maniac Reserve Bank governor and finance minister come in, flood the market with loose LVRs, cheap money, and they just inflated the hell out of everything. So we got a double boom, 2017, 2021. So with a double boom, you get a double bust, you get a hard landing. And I think the cycle has been reset. I would not be surprised if we see 2031 as the next peak.
Right.
So here we are in 2024. we should be in the middle of the cycle. I think the cycle got reset by Adrian Orr putting too much liquidity in the market. So maybe the long-term trend has been reset. But in a normal cycle, what you have is at the peak, values are peaking. Nobody can afford to buy the houses, so they start renting them. Even the rents are peaking. And so the government, or the Reserve Bank governor, pulls out high interest rates to try and quell inflation, slow things down. And so following that, and typically you get oversupply of housing stock at that point, because every man and their dog's a property developer, every taxi driver and hairdresser is telling you to buy houses, and everybody's in the market. So you get too much supply. So suddenly the herd panics and says, oh, actually, this can't continue. Rates have got too high. Asset values don't make sense. Nobody can afford this. It's unaffordable. So everybody stops. The lights go out. Asset values overnight drop 10%, 15%. And, if you need to sell in a hurry, and the development stops. And as it slides into a bust, values get harder and softer and softer, and assets get harder to sell. Developers stop. Lots of them go broke. And while this is happening, what you see is incomes keep going up over time, because with inflation, you get income growth and you get asset values falling. And coupled with that, you get less development, so supply dries up, and still people come into the country, so you get household formation from net migration across the border, and so more houses are needed and less are being built, and incomes are going up, so people can pay more rent. So the previous peak value becomes normalized. There's less stock around, and the values have dropped. So suddenly it's more affordable, higher incomes, lower values, and things become normalized by the growth over time. So that's boom to bust, recovery cycle. That's what's under it. So if I look at affordability, these are mixed median multiples for average homes. So it's mixed average multiples. This is John Butt's data. And you can see that the lack of affordability peaked post the 2021 boom, where house prices just inflated to the moon. And the multiple got to 12.8 in Auckland, for example, and the wider Auckland area over 14, just before the end of 2022. And since then, the asset values have fallen 20 to 25% across the whole country, including Auckland. And in addition to that, you've had year-on-year growth over that period of incomes, New Zealand household income growth rates of between 7 to 8%. In the 2023 year, it was close to 9. So incomes are up, which means rents are more affordable and previous peak values are more affordable, and asset values are down, which means affordability improves. Auckland's now under 10 from a peak of 12.8. So that's that whole property cycle, boom to bust, happening right on those graphs. What we're missing there is development consents and household formation. I've got that data. We're making too many houses, and we're still making too many houses, too many consents relative to the immigration. And the elephant in the corner is people leaving the country.
Yeah.
So it's not perfect at the moment, but it does mean that you can get in. And if you ask yourself, what's a house going to be worth in 6 to 10 years' time, it's going to be worth a lot more than it is now. So short run, I'm calling it we're at the bottom. But I don't think it's going to be rapid recovery of values. It'll just be more demand, more normalized environment. And, maybe the next peak is 2031, around 2024. So don't forget the peak is, I'm saying peak is 2031. Between 2028, 2029, 2030, that's when all the growth is actually happening. So it's not that far away.
Not at all.
It's much faster. I could have that cycle wrong. Could be another 2027 peak. But I just think it's all going to get pushed out. And one of the reasons it's going to get pushed out, apart from the cycle being broken, is immigration being slow. If immigration gets fired up again, if this government allows immigration to fire up, all that changes, because it's the migrants that buy the houses and drive the market. So against this, I want to talk about what most investors, advisors say to them if they go to a financial advisor, a banker, a conservative lawyer, a conservative accountant who's not in property, or if they go to a online thread anywhere about property and you take advice off the haters that hate the property environment. This is the mantra that comes out. And I have learned to not comment these days. Because rational discussion is not welcomed. But if this is a normal cycle, boom, downturn, bust, recovery, boom, you get your typical advisor who will come in and say, the market's gone down. I predicted it would go down. Asset values were too high. The market is down. This is crazy. It's going to keep going down. I predict it's going to go down to the bottom, because it's the worst it's ever been. I've never seen it less affordable. I've never seen it worse. And then lo and behold, it turns and it starts going up. And so on the first arrow as it goes up, what they're saying is, another bubble is forming. Watch out. We're going to have another bubble and lots of people are going to get hurt again. And then at the peak, they're saying, this is insanity. Who would buy houses now? We're clearly at the top. And it goes down and they say, see, we predicted it's going down. And the point is that these people, for them in property, at no time in the cycle is it a good idea to buy houses.
They're never saying now's the time. Let's go.
Yeah. And also at the bottom here, you get a particular line of rational discussion from these people saying this time it's different. So this time we've got DTIs. The Reserve Bank governor will never let us have house price inflation again. Or interest rates are so high, or the assets are so unaffordable, they will never be affordable again. And it's just horseshit because interest rates are going to be easing off. Household incomes are going up. Construction inflation, just from the cost of replacing the housing stock, which is going up over time, 3.5% long-term rate, that's going to inflate the value of the houses, compounding. So these people are not economists, they're not long-term investors, and they're wrong. The other thing they don't understand,
not only that, like they're saying that DTIs are going to kill it this time. In that case, why didn't the triple CFA kill it last time, or LVRs kill it when Bill English brought those in 2017? Nothing that fiscal policy can do will ever stop the normal flow, ebb and flow of the market. Because and this is my favorite comment of the year, really, the market is just the market. We've got so many people, we've got so many houses, and everybody wants to live in a house. Yep. It's just as simple as that.
Yep. When I go and buy houses, I look at demand and supply. So demand is, are people moving there? And what's happening to immigration, international migration into the country, and where are those people going? Then I look at supply. And on supply side, I'm looking at consenting, but I'm also looking at what the local city council is allowing to be consented. In 2013, Auckland was stuck in the 1960s. They had density rules. The unitary plan was not in. They were restricting the supply. As soon as they got rid of the density rule and brought in high density zoning, supply went through the roof, and now we've got an overhang of terraces. We've got plenty of places to live. Okay, so great socially, bad for investors. So where can we find a city where there's lots of people moving there with high incomes, where the city council is stuck in the 1960s, today in 2024? Where can we find that? And I'll tell you one place where we can find that is Hamilton. That's the city council is there, need to be sent a case of champagne from property investors because they are screwing the housing supply in Hamilton because they're resisting medium density residential standards, which is the unitary plan on steroids. They're resisting it from going in there. So has Canterbury a bit. So those are good places to invest where the zoning and the city council are restricting supply.
And why is that, do you think? Because, I mean, you look at Hamilton and you go, it goes out in all four directions. It's got a brand new motorway through it. They've got good transport routes. It's the only place you really can do the quarter acre section thing and go out for miles and miles.
I'm not going to guess because I don't know the Hamilton market at all. I would like to invest there, but I just have never got there. But I do know, I was speaking to a client today down there, and I said, is it true that they're resisting MDRS? Because I've been told that. He said, yep, big time. They're using, they're bringing the rules in, and then they're using infrastructure overlays and they've said half of Hamilton can't be developed with MDRS. because you're not allowed to connect to the sewer because they're saying there's not enough sewer capacity. So they use the services to restrict the zoning being utilised.
Yeah, and the same thing's happening in the South Wairarapa as well. Martinborough, Fielding, Featherston, you can't subdivide there at all. They won't allow it. They won't allow it for years and years. They literally got nowhere to put all the poo.
Yeah. Well, these advisors make good competition for Gilligan Road and good competition for you, Steve, because they keep their clients poor, they keep them out of property, and you and I and our clients do very well by knowing the better way. So where are we now? Well, I say we're at the bottom. That's my view. There's lots of other people saying it too. Real estate agents always want guys like you and I, Steve, to say that, but the last 3 years we haven't been able to say that because it just hasn't been there. But I really think it's there now. Yep. And even the Reserve Bank governor agrees. He's taking the foot off. So let's see what the brokers said to me today. So there are two fantastic brokers. One of them is David Windler, who works very closely with Steve's client, and another one is Chris Pedersen, who GRA worked closely with. So Chris said to me that test rates have been dropped by 0.5%, which is 50 basis points. So what that means is instead of testing you at 8.5 or 9%, they're testing you at 8 or 8.5%. So you need less cash flow to borrow the same amount of money. And that means you can borrow more. You've now got liquidity where previously you didn't. And as the OCR drops more rapidly later in the year, that's going to flood liquidity into the market. So I asked Chris, had he seen any impact from DTIs, debt to income ratios? So DTIs are a ratio restricting your debt to be, for investors, 1/7. So if 7 to 1. So if you've got 100,000 of income, you can borrow 700,000 of investment debt. And there was lots of concern when these were coming in, but they were set very carefully at or above the testing rates of the banks. They were set so that they didn't impact what was already a recessionary environment. And I think that has been well done. DTIs have not caused any impact in the market, according to Chris, and I haven't heard it from anyone else. He said test rates are still higher than DTIs. As rates drop, DTIs may weed out the weaker cash flow borrowers. And to that, I added to my view is you could see as the rates drop, the Reserve Bank governor bring DTIs down to 5.5 to 1 or 6 to 1.
Maybe. Yeah, they could tickle it. Yeah,
and that would be the right thing to do, because what we don't want is another 2021 where we get another housing bubble and everyone hates property investors even more. We want long-term growth. If we've got 6% straight line or 7% straight line, everybody's getting a healthy return. Rents don't go crazy. People don't get too rich or too poor. It's moderate growth. So I do hope he does use the DTIs to not overdrive the market one way or the other, just to stabilise it. Chris said that KPM, Chris Pedersen Mortgages, are absolutely flat tax, second largest month in their business history last month, off some of the worst months earlier in the year in their business history. So that's extremely significant that they are, the optimism is returning to the market because the brokers know about this first.
Yep.
And you'll hear that Dave Windler's got exactly the same thing going on at the moment.
Yep.
Chris said that there's a lot of pre-approvals that are coming through. People are buying stuff. They've got the pre-approvals for them. They're suddenly transacting. He said that there is a rule change from government that's coming off the back of CCCFA that allows you, because the banks don't have to look at the granular operating expenses of people, so they don't have to check how much you spend on coffee a week and all the nonsense, how much you actually spend, because they can use template expenses. They're often less than the reality. And he said that, coupled with the test rates dropping and coupled with banks taking a much higher percentage of rents because the interest deductibility rules have been eased, he said those three things have culminated in a lot more liquidity, and it's showing up because people are suddenly able to borrow where previously they couldn't. And that's turning into real demand for purchasing. So he said that there's very little construction finance going on, which is normal in a cycle. You've got an overhang of too many houses and no confidence. you wouldn't expect there to be a lot of construction going on. There's not. He said that he is seeing a resurgence of traders, the diehard investors like Selesh and I and Steve here, who want to build, renovate, revalue, recycle. He said that's been going on all the way through the downturn. But he said new build finance is still soft. He said I said to him, what's the most exciting thing you're seeing out there right now? And he said government common sense flowing through into banking. So he said
you can see this,
yeah. He said that there's plenty of non-bank lenders entering the market, like Liberty and Avanti. So the advantage of these guys is if you've got $1 million worth of debt with a bank, they might test you at 8.5% principal interest, which is actually 10 or 11% of the total debt. These non-bank guys test you at 6%, which is their actual interest rate. So it's just 60 grand a year that you need to service the debt instead of being tested at 10, but the actual cash rate from the bank's 6, so there's a massive difference between the testing rates and the actual rates. And so with Liberty and Avanti, these guys are getting a lot of debt at the moment because their testing is softer. So that was Chris. And then I asked David the same questions, and I said, so David, what are you seeing with DTIs? He said, no impact. He said he's starting to see a bit of FOMO in his client base where people know we're at the bottom and they want to get in before it goes up. He said there's lots of stock out there and everyone knows it, so they're still being careful. He's not seeing values go through the roof. He's just seeing investors getting going. He said consenting is still high. By that, he means lots of tail end stuff being built. He agrees 2024 is the bottom. He said, I said, what's most exciting to you? He said, to see confidence returning, to see sale and purchase agreements flowing in that he's funding.
Yep.
And to see short-term activity in the last week. It's picked up just post the Reserve Bank saying they're going to keep putting rates down. So good to hear from a couple of real estate agents earlier and a couple of very senior experienced mortgage brokers in the game. They're all saying the same thing.
Yeah.
So, yeah. I wanted to briefly show some of my stuff that I'm doing because in our culture at GRA is copy what we do, get what we get. And this is exactly the sort of stuff that Steve's going to be teaching you guys if you become a client of Steve. But I take a bit of a tax twist on it. So if you build to sell, you pay tax. If you build to hold, you don't pay tax. If you trade houses, you pay tax. If you buy long term, you don't pay tax. And the trick to be a sustainable investor is that when you run out of investing capacity to start trading or start developing to sell, and then take the money you make when you trade or develop to sell and then put it to your holds. Your pot gets bigger. You can get bigger with overall without inflating your loan to value ratios by using a trade strategy within your overall big picture of your holding, because the wealth you're creating is reducing your gearing on your buy and hold portfolio.
Absolutely.
So I won't bother reading the slide. I will say that Selesh and I use a lot of build to rent and social housing. We love social housing. We were doing that before the interest on deduction rules exempted it with social housing. And that's because when you're in social housing, you get indemnity for damage to your house. You get 100% occupancy. So when the tenants trash the house and move out, they still keep paying your rent while they fix your house. And they manage the house for you. So if they're managing the house, you don't pay 7 or 8% management fee. So all the way through, you're winning. And, we really like it. Do you do much with social housing, Steve?
A little bit here and there, just one-off houses. Some of my boarding houses are rented out to social housing providers. If you get 8-9 bedrooms, they're likely to put in a live-in manager and some people who are unable to live unassisted, and some of those can be really lucrative.
Well, you guys are the kings of trading, really.
Yeah, we do a lot.
Yeah, and we're hardcore buy and hold people who reluctantly trade. We see it as a necessary evil to build to build our portfolios larger. So
I
it's a good blend.
I still stand by the fact that, like if you want to trade, the best way to trade is to go and find hold properties. And if you have too many of them, you pass on the ones you can't settle yourself. Simple as that.
Yeah, did right. So and last year we built this. It was completed and rented in February this year. So we built, the land and subdivision was 1.5. The building cost 4 units, 120 metres each. 1.5, total cost 3 mil, revalued at 4.6. So we've got an equity gain of 1.6. We've rented that to social housing. It's cash positive. We've got a net yield of 6.5% on it after OPEX. So easy stuff. It's cash positive on 100% funding. We don't 100% fund it, but it could be. And so at the moment we're building down in Papatoetoe. We're building 8 of these. We're keeping these. 6. There's 6 actually. 6 in Papatoetoe. And at the same time, we're building 8 horrible little units in Silverman Road and Te Atu South.
Yep.
And for the record, we didn't design them. The developer that was selling them needed to sell them. He wasn't able to develop them, so we picked them up. Land consented with building consent done for 1.35. Absolute bargain.
Yeah, fantastic.
So build cost is 2 million, so it's 3.4, and there's 2.3 million gain in that. So we buy and flog that, take the money, we pay tax on it, so we'll end up losing GST and tax. We might get 1.4 out of that after tax. We put that into this.
Yep.
This one here, which has similar sort of margin, and the LVR is very low. We can keep the whole thing. So in a cycle of 15 months, we end up with 6 units with low LVRs with great cash flow.
Yeah, beautiful.
And you can use exactly this concept because most people can't do this. Most people don't have the money, and it is a sophisticated thing. And there are tricks to the trade. I'm not here to tell you how to do it, but that is a tricky thing to do. You need to be experienced. But exactly the same strategy: buy, renovate, sell, buy, renovate, hold. You're doing the same stuff, right? Which is Steve's core business. That's what you do so well. This is that development I did in the South Island, Steve, 81 sections.
The Duffield one, yeah, lovely. So that's huge, eh?
Well, all gone, settled, done in the bank, and I'm now starting another one in the same area. This is a stuffed up slide for some reason, but this is I've got these consented, and this is an example of something going wrong. So I paid too much for this land. I've had this consented, and the end value of the units at the moment don't make sense. So there's margin in it, but not enough. But in 3 years' time, those units will be recovered in value, and they'll make sense to build them. It'll make really good money in 3 years. So no panic. I've got 2 house sites here. I just rent them out, leave the existing houses there, and sit on my consents. And when the housing environment's perfect for it, and I'll pick the point and I'll build them. So that's the beauty of land banking and getting your development consents. The trick is don't knock the house down at the beginning. Leave it there right till the day you turn dirt. So, Steve, I wanted to ask you if you've got some deals that you've been doing.
Yeah, we've been doing a lot of one-off deals as well. I negotiated one recently. GV was around 1.4 million. Vendors paid 870,000 in 2019. I saw that it was on the market for 795,000, so I offered 625,000. We've settled on a price around 730 grand, so it's about 11% net pre-renovation. Probably needs a new roof, about $30,000-$40,000 worth of roof, and maybe a $50,000 tidy up. And it's a 4-bedroom family home upstairs with a 2-bedroom flat underneath it, with on a hill with views looking out over a harbour, central Wellington. And then I jumped back in with the same agent who I've done a few deals with, and tried to have a tickle of another deal just today. Actually, gave her a message and said, "Look, can you get us along tomorrow? Let's have a look at it." Buyer inquiry was 845. Best offer at tender was 751. So they reduced the asking price to 769. 3 working days later, they had another 100 grand on the table and sold it for 850. So sometimes if you drop the kimono and show a little bit of skin there, maybe you get a whole pile of flock of people jumping back in on it. So the next one I'm going to is an auction in Wellington tomorrow for a couple of mortgagee sale townhouses, apartments actually, right in the middle of central Wellington. Going to see how those go. They've got a heck of a lot of costs and expenses, but it's also the start of 32 properties that are being liquidated, and these are the only 2 that are actually standing. So there's something like 30 bare sections and 2 apartments. So I'm hopeful that the liquidators on this one will be really interested in getting rid of these ones to start with, to sort of make their job easier later on. We'll see what sort of reserves they've got. And just doing my normal thing apart from that. One of the things I am seeing a lot of is a lot of Auckland investors who really can't get more than a 7 or 8% return in Auckland without going into development stock or scruffy stuff, moving down to Wellington or Christchurch or even Queenstown, believe it or not, to try and find yield, which is surprising and doesn't happen all the time and really interesting.
Well, it's interesting you say that, because 10 years ago when I did my deep dive and I wrote my book, Property 101, Auckland was the best place to invest because it had tight supply, city council that was blocking development, and huge migration here. And the rest of the country had surplus housing stock, places like Hawke's Bay, Rotorua. There's just too many houses there, and Auckland was tight. Unitary plan hit, supply rolled in, house prices went really high. So the conditions kind of went the opposite, where a lot of people got displaced out of Auckland. We had a massive amount of immigration over that decade, 2013 to 2023, and the regions, just all the surplus housing stock got absorbed. And actually what's happened is it switched around. Auckland's actually got too many houses now, and a lot of the regions are really tight for supply. And we know this because we talk to our social housing people, and my point is that we're now getting Auckland rents in Rotorua, and the Rotorua prices with Auckland rents. How good! So there's yield out of Auckland. That's why we've moved out of Auckland. We actually cashed up our stock in 2021. A lot of our house in Auckland, and we went. I went to Canterbury and I went to Rotorua, and that's not because they're the only places. It's just 2 places that we knew. And the yield in the regions is phenomenal at the moment. Auckland rents and regional purchase prices. So I'm all over that.
And the flip side of that, I think, too, is that when the New Zealand property market does warm up, it starts in Auckland. And so your mum and dad renovators who aren't looking as closely as we are, look for stuff that's scruffy, stuff they can add value to, stuff they can do a few weekends on over a couple of months and add some value to it. And they prize that slightly more highly in this point in the market than they do renovated and finished and complete stock. And so we're actively looking at both, because sometimes at the moment you can buy something for the pre-renovation cost, which is done and is ready to rent and ready to just put into your whole portfolio. We're finding that really exciting.
It is interesting the way the purchasers can often do not distinguish between renovated and unrenovated stock. That's just batshit crazy, isn't it? There's 80 to 100 grand difference between the 2 items, and somebody will pay the same value for renovated as opposed to unrenovated. That is crazy.
And the thing is that they believe that for $13,000 worth of supplies and 3 weekends and a few conversations with a guy down in Bunnings, they can change it by $100,000, $200,000 in value. And it's just not the way that it works. It is a bit harder than that. So they just don't understand what it is they're looking at.
One thing I have found in the regions is that they are surprisingly expensive to renovate, from my perspective as an out-of-towner. So, for example, in Rotorua, ridiculous plumbing, electrical, and building costs, drainage. Getting a drain ladder to turn up is absurd. So we've been sending people down from Auckland because we've got a lot of houses there and we're subdividing them. Actually, I'll say this to you, Steve. Another thing that I'm looking into at the moment, because we've got a lot of land in Rotorua, and I was thinking that MDRS would roll through Rotorua. It's Plan Change 9. And we would be able to do what we did in Auckland and start building terraces as Plan Change came through. But actually, cost of completion of, say, a block of 6 to 8 terraced houses in Rotorua, there's no margin in it, because the end value of an 80-metre unit is close to the cost to build it. So that market and that strategy just goes to show that strategy works great in Auckland, but it doesn't transfer down there, the terraces, because the values are too low.
Yeah, and the construction costs the same.
Yeah, so something that Selection and I are doing at the moment is we're up in China, and we're looking at modular homes. To see if we can import, and it's full of risk because you've got to get through brands and you've got to get through the consenting process. But we've all of our sites are 1,000-meter sites. So if we can put two 100-meter houses in the back for $200,000, we get another $1,200 a week on 200,000. So
it works.
$60,000 on 200,000. It's nearly 33% gross return.
Yep.
So we're working on that. Yeah, it's expensive to get it consented.
I bet.
So I thought I might rip through some tax and do some tax. Are you up for that?
Yeah, terrific. Rip in.
So look, actually, there's nothing dramatic that's changed in tax. So I'll just, I'll rip through this because there's not a lot to it. But we're in the new Brightline period now. So Brightline's been reduced to 2 years. Hallelujah. So it applies to all residential property sales after 1 July last month. And there's a bit of confusion out there about how the dates work on this stuff. So for Brightline, the date you're deemed to have bought it is the purchase date is the date of settlement, which, if you like, is the latest IRD could get.
Yep.
And then the date you're deemed to have sold it is the date you have a binding contract, which is the earliest. So they're trying to shorten the period that you have in your contracting window so that Brightline applies to the maximum number of contracts. So with that in mind, and with the new Brightline period, let's look at a case study. So Calvin bought a property in 2022. He signed an agreement to buy it 20th of January. He settled it February 2022. He wants to sell it now, so he entered into an agreement in June 2024, 3 months ago, but he delayed the settlement until August 2024 because he wanted to settle after the 1 July 2024 rules. Will the sale be subject to Brightline? And if so, what Brightline period? And so the answer to this, of course, are all trick questions. The purchase date is the date of settlement, which is 15 February. The sale date, when the Brightline stop clocks, is the date of binding agreement. So the date of binding agreement was before 1 July. It was in March or February, whenever it was prior to July. So therefore, 10-year Brightline rule applies because the date of the agreement was pre-1 July.
Yep.
So if the agreement was entered into after July, the 2-year Brightline rule would have applied. So the date of settlement's not helping here. And the moral of the story is I hope no one has sold property prior to 1 July by binding agreement because it's actually binding agreement after 1 July that you want. We actually had a couple of clients over the period just in July, in June, where we had them cancel their contracts and remarket them in July to get them out of Brightline.
Yeah.
So that's it really, and there's not a lot of movement there. We're in the new national government driven regime, 2-year Brightline period. So that will make it a lot easier to sell your properties without having massive capital gains tax effectively. For interest on deduction rules, the old rules applied to the last financial year to 31 March 24. The new rules are applying from 1 April 2024. The new rules are 80% deductibility for the current year up to March 2025, and then from 1 April next year, 100% deductibility.
Yep. Which should start another little property boom of its own, really, shouldn't it?
More good news.
It is.
So social housing still get 100% deductions now, but that's discussed many times. I'm sure everyone knows that, but that's such a good thing for investors. That's pushing confidence back into the market. So what this does mean is that if you've got property that you've been owning for a couple of years, you've probably noticed that you're starting to get taxable profits last year, 24 and 23, and that's because you're only allowed to claim half your interest or 3/4 of your interest the prior year. And so that's causing you to have to pay provisional tax this year. So when you get your accounts coming in, tell your accountants to adjust your provisional tax because you get 80% interest deductibility, next year 100,
Yep.
and a lot of people are actually going to end up with tax losses again, which are still ring fenced, but at least you won't have to pay provisional tax on a fake profit
Yep.
manufactured by a government that hated property investors.
Yep.
Yeah, so keep your eye on that with your accountants. So action point, check your provisional tax. You'll be able to adjust it down to take into account the increased interest deductibility. So one question we often get is, what about disallowed interest deductions? So if you were only allowed to claim half your interest and therefore half was non-deductible, do you get to offset the non-deductible portion if you on anything? And the answer is only on a future sale if the property is taxable. So if the property was caught by Brightline, you could offset the interest that you couldn't deduct against that. Or if the property was caught by tainting, you could offset the interest not deducted against the tainted gain. But if it's not taxable, you get no offset. You don't get to claim it. It's just black hole expenditure. You've lost the money. In brief, the trust tax rate for the current financial year ending 31 March 2025, the one we're trading in now, the trust tax rate is now 39%, aligned with the top marginal tax rate. If you have less than 10,000 income, the trust tax rate in the trust tax rate is 33%. That's a de minimis rule. So most trusts will be at 39%, but the smaller trusts will be at 33%. So this is applying to income after 1 April this year in the current financial year. So implication is you're all paying 39% if you've got income in the trust, and you can't claim the de minimis rule. And that means if you've got a company owned by a trust, you're going to pay 11% top-up tax as the difference between the company tax rate at 28 and the trust tax rate at 39. Now, if you have qualifying beneficiaries that you can allocate income to, who are children who are 16 or older, or people who have lower tax rates in the trust, then you can allocate your income out of the trust to those beneficiaries and average the interest rate down to their marginal tax rates. So that's called income splitting. That is the intended use of a trust. It's not tax avoidance. It's the government's intent. It's been done since the day is long. The trust regime in New Zealand's 150 years old. That's how it works. Income splitting is not tax avoidance. It's how trusts work. Of course, we've got new marginal tax rates from Nicola Willis, announced recently. Here they are here. It's just a tweaking of the old threshold. So first 14 grand's at 10.5%. If you've got a trust, you want to be allocating income to your kids using that 10.5% tax rate if they're not otherwise earning income. Do you have any kids at uni, Steve? Or
Not at the moment.
No?
One coming up shortly, probably.
So if your kids are 16 or older, they're tax efficient, you can give them a distribution at 10.5, which is 29% less than the trust tax rate, near enough.
Love that.
So you use this, spread the income across your spouse and your kids, and average your income tax down. These are the new rates; they're much lower.
Yep.
So I've only got one last thing really to share on the tax side of things, and that is what I consider to be a structure that most property investors would want to take advantage of. It's a good structure. Corporate tax rates at 28%. Most people are going to want to put their buy and hold portfolio into an ordinary company and pay tax at 28 because that's less than the marginal tax rates for most taxpayers. So if you're in a look-through company at the moment and you want to become an ordinary company to get 28%, because LTCs use the shareholders tax rates. So if you're a shareholder and you're paying tax at 39, you don't want to be LTC with the rents flowing through to you. So you want to be a company, an ordinary company. So yes, you can migrate a look-through company to be an ordinary company. There's a pathway to do it. There are severe tax implications because when you revoke your LTC election, it's deemed that you as the shareholders have sold the properties back to the company, and Brightline can apply to that, and you reset the Brightline clock. But we can show you how to get through that. It's much better with a 2-year Brightline clock being reset. Yep. So with the top-up tax rate being 11% between a company and a trust, the question comes, what if you don't declare a dividend and you keep the money in the company? at 28%. How do you get access to the cash without triggering that 11% top up? So this explains it. Let's say that you're a property trading company and it made $1 million. So you paid 280 grand tax. So you got 720,000 after tax in the company. If you take that out of the company to the trust, you are deemed to have a prescribed rate of 7.89%. So you pay tax on deemed interest of 7.89%, which in this example is $15,900 on your own money, which is the benefit of the interest that the deemed interest, which is the benefit of taking the money out of the company. So clarifying, the company has paid tax at 28. If you declared a dividend to the trust, you'd have to pay another 11%, which is another 110 grand. But you've avoided that by not declaring the dividend. You just loaned the money to the trust. If you just loaned the money to the trust, you have to pay tax on deemed interest of 7.89%, which is 16 grand a year. So you can't do that without an adverse tax consequence. So how can you get the money out without the adverse tax consequence? Here's your cunning plan. You have two companies under a trust, and one company can lend the 720 to the other because it's within a group. There's no deemed interest on loaning the money within the group. So instead of paying the money to the trust and out to the IRD, pay it to your own company, and you keep the 110 grand, which is the top-up tax you'd have to otherwise pay, and that 110 grand can go to your bank and pay down your debt. So you actually save interest on 110,000 of the IRD's money every year, which has a compounding benefit a lot over 10 years. And if you're making this much money every year, you're getting that every year. That's a lot of money. So lend the money into company, no deemed interest. You can get your money out without paying the top-up tax. It's only a tax deferral, but that's pretty much one of the best structures we've got for investors at the moment. And whether it's a property trading company or that's your architectural business or engineering business or whatever it is you do, that company can drive the surpluses you've got at the corporate tax rate without paying the top-up tax into your portfolio. That's my point. Back to you, Steve.
Excellent. And so, look, mate, we've worked together we were talking about today, like 20 years, right?
Yeah, it is.
Crazy. I think that the boot camps that you and I do have become kind of an intrinsic part of every serious property investor's educational cycle. Would you agree with that?
Yeah. I mean, you and I were standing on the same stages together 20 years ago.
Yeah.
And at the beginning, we didn't know each other, but we were in the same events. And then we sort of formed much closer ties about 15 years, I'd say.
Yeah, for sure.
I remember back in the Phil Jones days. Do you remember him?
Oh, God. Don't start. You had to do it, didn't you? Oh, you're a wind-up.
Yeah, well, I mean, I was there too. And we were telling our clients to buy houses in Otara for 80 grand.
Yeah, and people are telling you were nuts.
Absolute madness, And I remember one of my clients believed me and went and bought 40 of them. All through South Auckland, average of 80. Then it became 120. We thought that was mad. And, those houses are all 700,000 to 900,000 now, times 40.
Well, I remember Sean Wood absolutely frustrated and stopped buying houses when they got to 250 grand in South Auckland. And then I remember being the first person to sell a house in Nainai in Lower Hutt for over $500,000 ever. And now we're buying houses for $600,000, $700,000, $800,000 in Wellington, and that's still half the GV that they are now. Yeah, the madness continues.
There's another cycle, and we're reading it right. I'm sure you did the same. Celeste and I cashed up Auckland in 2021. We thought it was madness. We thought this is an insane bubble, a COVID bubble, Adrian Orr's bubble. We sold, and we went to other areas for cash flow. And in the downturn, we've continued investing because it made sense long term. And that's what we preach, right? That's what we preach. You get in with the right people who understand these long-term cycles, who understand the strategies in the short term, you do better.
Yeah. And we see it again and again. And the only thing that really stops people from following that advice and doing it is fear, and fear is just a lack of knowledge. And that's why we put on boot camps and stand on stage and we pull out the whiteboard and we teach people some stuff. And I think that the things that we teach now are universal and they're valid, but they're also timely and they're up to date with the current market.
So when is your next event?
Well, bloody thing. Yeah, so we're doing another Success in Property Bootcamp. It's at Eden Park in the Grand Room. We've got a role going with this venue now. It's a really nice venue. It's a very big room. Having said that, we've got a few hundred people coming now, and we're starting to do the usual this time of year, run short of tickets. It's 15th of September 2024, which is a Sunday, which we find just works with people's plans with school sports and kids and bits and pieces. It's a full day event, and as we've covered, we've got a lot of guest speakers in there. But mainly what we've done with this event is we've updated the living heck out of it for the current market, because even 6 months ago, if we were talking about the market 6 months ago, it would be a stellar difference to what we've actually got going on in the market today. So we've rewritten some core portions of this event, but kept the intrinsic value to the event, which is, this is how you sort out your retirement. This is how you buy houses long term. This is how you sort out your own superannuation. And it basically explains the way that I've been able to put my portfolio together, and you get a chance to stand on there and talk about tax and accounting and structures and how you've put your portfolio together, which is a really impressive portfolio as well. And we get a chance to just explain our rhetoric in the marketplace to as many people as humanly possible. And as you and I know, like even from this webinar and some of the questions that have rolled through tonight, people believe that we somehow breathe different air to other people, and we've got, these fantastic skills and powers that nobody else does. But it's totally wrong. And what we do have is a selection of our own clients who are actually in the marketplace doing exactly the same thing we are right now, using the same tools that we've given them, doing exactly the same and getting the same results that we are too. For instance, I had a client very recently that I sat down and talked to in Taupo, who had just bought 4 houses for $1 million in Palmerston North. Now, I heard that instantly and went, $250,000 a house. They've got to be, semi-detached, as in connected houses. They're not, they're standalone. Then I figured, well, there must be 2 bedrooms. Well, they're 3s and 5s. And it was just a magic and amazing deal that created a massive amount of cash flow, and it's a life-changing event for most investors.
That because is actually a very, very good thing about you, Steve, if I can just butt in, is that you've got investors from entry-level stuff for people who's getting going through the more sophisticated, larger stuff.
Absolutely.
And that ability to enter at different levels has helped a lot of our clients, because quite often, I'll be talking about developing property, and a lot of people can't do that. And so to be able to get a group like you that works from grassroots stuff through to quite large stuff is excellent for them to be able to access that network.
Yeah. We largely complete newbies all the way through to, people with tens of millions of dollars available for investment right now, and everything in between. But what we really like about this investor panel is actually putting real everyday Kiwis on stage and saying, well, look, a year ago I was at this point, I'm now at this point, and this is how I've done it. And I think that there's a lot of value in that within the program as well. And obviously, we've got our specialists that come along, including yourself there, Matt, and Dave Windler, who you mentioned earlier, and a pile more people as well, who are showing exactly how their piece in the puzzle fits in and how to use them as experts. And obviously, all of these experts came about because, it's Steve Goody, property coach. These are the people that I actually use in my business. And that's why I recommend them, for no other reason, because I actually use them and found them uniquely useful to my investing as well.
Steve, I've been severely criticised for being photoshopped in that particular image there.
It's a beautiful photo, Matt.
I didn't do it. Amanda did it.
Dave Whitler looks exactly like that, I've got to say.
Oh, I know. He's got good skin. Good on him.
So we should call that photo of you like complimentary, shall we? Or
yeah.
I love it. The other thing I love about our event is that there's normally 400 people in the room, and we recommend that people bring some business cards with you if you'd like to, and do some networking within the room, because the next joint venture partner that you might want could be sitting in the room there ready to go with you as well. And lastly, to promote that, we actually put lunch on at my event too. So for the cost of the ticket price, you actually get to eat a full lunch in the room as well. So you get a really good chance to sit down and have a really good conversation with any other people that you might find in the room that might be useful to you. Now, we're doing a special webinar only offer during this series of webinars, and we want the information that Matt's given you tonight to be uniquely useful, but we'd also really like you to take it on to the next level and spend a day with us at this particular boot camp, because it's just so much more useful to actually physically be in the room with the people and ask the questions live in the room. So if you buy before the 31st of August, so this gives you 10 days to buy your ticket, although we would recommend you grab a ticket tonight because we are running out, particularly VIP and upfront tickets. But if you buy a ticket before the 31st of August, you go in the draw to get your ticket price back, and we're starting that promotion from tonight for the next 10 days. Plus, we're going to do a draw for 2 people who, whatever ticket value you buy, we'll either upgrade you to VIP, or if you buy VIP, we'll charge you for a standard ticket and give you VIP. So we're doing a few freebies and bits and pieces, which I think is really cool, just to motivate some people as if the current market isn't enough to give you a big jump. And all you need to do is go to stevegoody.com/Auckland, real simple website, stevegoody with an EY.com/Auckland, and enter the code webinar to get the 25% off tickets. Now, as per the last couple of webinars we've done, we're going to do this strictly for the first 25 tickets sold tonight. But if you do buy a ticket in the next 10 days, you do go in that draw to get your ticket price back or get upgraded to VIP. And then all you need to do is come along to the event on the 15th at Eden Park. There is heaps of parking, which is another reason why we really like that venue. It's a great room. We're going to put lunch on, and we're going to put on an incredible show of exactly how to sort out your retirement and your wealth creation for the next few years through property investment in, as Matt says, the absolute perfect storm of timing of when the market is absolutely primed to go. Like, I've written this much notes tonight. I don't know about you guys, but I've been scribbling notes down all night. So I think it's absolutely, completely set to go. Now, I've got 3 more webinars over 3 more Wednesdays in this series to go. I'm going to do one on my own and talk to you about how to get the absolute most out of this event. I'm also going to talk about property trading with expert property sales and trades person Shane Carruthers from Nexus Property, based in Auckland there. And then I'm also going to grab Mark Trafford, who's one of the best renovators and people at pricing renovations and demystifying and making that not scary in the marketplace as well. We're going to chuck him in there as well. So there we go. If you've got any questions, put them in the comments on the side there. In the meantime, the website is up on the screen there. All it is stevegoody.com/Auckland. Enter the code webinar to get 25% off. Right, Matt, do you want to bang out a couple of questions, or are you done? Are you cooked?
I don't mind a couple of questions. Hopefully I know the answer.
All right, a lot of people jumping in there and grabbing tickets. A lot of good positive feedback on the content tonight, Matt. Appreciate that. Sean asks, is the boot camp online? I'm afraid it's not. It's one of those things that you really do need to be physically in the room to get the best benefit out of this. The speakers are in the room live. We're not doing pre-recorded. We're not doing anything like that. There will be massive big screens. I get this question every year too. If you do have a hearing difficulty, we can put you right up the front. So just let us know when you purchase your ticket if you have that particular problem. But we have massive screens so that everybody can see as well. It is an Auckland-only event. Karen says, thanks for all the words of wisdom. A lot of great feedback from this webinar. Must be your brand new bar background there, Matt.
It's all photoshopping.
Do you reckon? It's probably fake, eh? Getting bowled or balled too? What time's the finish on Sunday? We try to get it pretty much wrapped up by 4:30. We know people need to get away. It's a pretty big event to shove into one day, and we work pretty hard on our timing to not run over, because some people really like to talk. Hey, Matt.
I wouldn't know.
He's got a lot of content, this guy. Can't give him too much grief. Great, so guys are booking their tickets and getting flights sorted. That's excellent. And once again, that website up on the screen now if you want to grab one of those last of the 25 tickets before we run out today.
Steve, thanks very much for having myself and GRA here. I'll probably love you and leave you.
Absolutely. Thanks so much.
Look forward to seeing you at the event.
Excellent. Thanks, Matt. Really appreciate it tonight. Thank you so much.
Thank you. Good night.
Cheers.